Well, welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, is your business a captive candidate? Part 4 in our series on captive insurance companies, the business alternative, with author, speaker, and nationally recognized captive insurance expert, Wes Sierk. Welcome to segment 4, Wes.
Thank you.
Well, I want to kind of sort out now. Small business is the backbone of America, but I don't know how small I can go if I want to create a captive insurance company, and is it worth it? So I want to talk about some minimum requirements now to kind of get our audience up to speed, especially our business audience. This is going to go out to a lot of business people. We want to kind of say, hey, is that really for me? So why don't you walk us through, what am I looking for at the minimum?
I'd say a good place to start is people that are paying $1 million or more in health insurance, workers' comp, general liability.
So that's the bottom threshold. And how many companies are paying that?
You'd be surprised.
Even small mom and pop?
I mean, think about it. The average cost now for medical care or for medical insurance is $12,000 a year per employee. So where before it was $4,800, $5,000. So a lot of businesses have seen their medical insurance double over the last 5-6 years. So that's, where people were paying $500,000 before, now they're paying $1 million. At $500,000, it was irritating, but at $1 million, it's a big problem.
Okay, so if I'm doing $1 million, and that could bring that threshold.
Probably 90 employees.
So
90 employees, you're doing $1 million.
We're not talking a big corporation here. We're talking small.
Correct.
Okay, so if I'm around 90 employees, 100 employees, and I have $1 million for at least going to health and general liability, workman's comp, I should look at this.
Yes.
Now I'm going to have some liquidity up front. So what is my check I'm going to have to write as a reserve account if I'm thinking this way? Let's say I'm hitting your numbers right now. I'm actually satisfying your requirement.
Yeah.
What's the minimum I'm going to have to write to create this?
Probably $200,000 in capital and surplus.
Okay, so you're going to have to park some reserve money. Yeah. So there's money there. You're going to have to create an entity. Now, I noticed you said it could be an LLC, but it's really going to be taxed like a C Corp. So if I have an LLC, I can still do it that way, but it's the taxation I'm going to get is on the C Corp.
It has to elect to be taxed as a C Corp. You can have it as a pass-through, an LLC on the 1065. You can say it's a pass-through, or you can elect it to have it taxed as a C Corp. So if you want to create an LLC, that's fine, but it has to be taxed as a C Corp.
Okay. So now I've set that up, and so if I'm at this size, I can write that check. I can create this secondary entity, this insurance company, and I have $1 million going out right now. I'm a beginning candidate.
Correct.
Okay, so that's my threshold. All right, so if you're watching this show, you say, Steve, I have $1 million worth of insurance going out the door, and on top of that, that's still my money. It's just in reserve. I'm just trading from one pocket to the other. It's not like I'm losing it, right? I'm not paying a fee.
Yeah, and there's certain jurisdictions where you can finance that with a letter of credit. So we have some clients that capital and surplus, the initial capital and surplus, they actually use bank letters of credit to finance that $200,000 to $250,000.
What's the threshold to have? I'm sure people don't want to use their cash. What would be the threshold for a bank letter of credit?
It's whatever if it's $200,000 to $250,000 in capital and surplus. If your bank gives you a $250,000 letter of credit that you can park with the Department of Insurance, then you're fine.
So you may not, if you've got good credit and a big volume of credit, you got headroom here, you could use a bank credit without coming out of pocket.
Yeah, many banks now, or many businesses actually don't want to part with their cash to set them up. And banks have become looser as far as their lending standards. So it's not uncommon for our clients to have $200,000 to $250,000 in excess money on their line of credit that they can just have the bank peel off a letter of credit to the Department of Insurance.
I'm thinking of, if the Republicans get their way and they take care of Frank Dodd, that could change our world. I mean, that could really change our world. Okay, so now I know the minimum. Tell me what the average captive looks like in your mind. Not the smallest one like we're talking here, but what's the average company that you've seen when you introduce this to them? You're going there because you already know they've met the minimum thresholds. What are they going to get? What turns their head when you bring in captives as an idea?
The ability to capture the underwriting profit. I mean, when I used to sell insurance, you're always trying to say insurance is the best thing in the world. Many financial advisors who are out there selling insurance try to pitch insurance as the best. P&C agents are saying this company's better than that company, which is better than this company, and here's the price. They really just market on price. It becomes a commodity. This is actually the anti-insurance sale, because you're saying the insurance companies, the insurance industry is rigged. One company isn't better than any other company, but it's the industry itself that insurance companies are now the invisible banks in our economy. So you can't beat the insurance company, so you might as well join them. So that's really the sale.
I just want to repeat something here to make sure I got it, Wes. If I have strong credit with my bank and I get a bank letter of credit for my reserve, I file it with the insurance company, I didn't put any money out of pocket for that. Then I still have to pay my insurance. I've been doing that anyways. You're coming in now saying we're going to wrap this in a captive insurance company. The cost is only setting up the accounting and the actual company's entity, the cost of doing that, right? Constructing a corporation. That's a pretty attractive thing when I'm looking at, hey, if I did a good job at management, I'm pretty much doing the same thing I'm doing now, and that's extra money for almost no money out the door.
Correct.
So if that is, so can I redux line of credit? If you got a big line of credit, it may not cost you anything for reserves. You just have the credit. Number two, I already was paying all these insurances anyways and getting the deduction. The only difference now is since I'm the company, I might be able to keep this money and do whatever I want.
Correct.
When you explain that to a small business, I mean, do they jump for joy or?
Well, a lot of them are, until it goes to the CFO or their accountant. And then the people that make the money, I mean, the business owner, patriarch, matriarch, closely held business, they're the ones writing the tax payment every single year. So they love the idea. But the CFO and the accountant sometimes look at this and say, well, you don't want to take risk and you don't want to do this, and let's keep it in the traditional market. And then let's say it goes to the internally in the company, the person that handles the insurance. Many times in the HR people, they just see this as going to be more work for them because now we have to get networks, we have to get all this other stuff. I mean, it is not more work for them, but it's that fear factor of, will this cause me more work for no upside? But once you sit down and explain it to the CFO and the accountant, then it becomes much easier because they usually get on the same page. Once they realize, look, if you're paying $1 million before and we can backstop this, so worst case scenario, you're no worse than where you were before. Why wouldn't you do it? If you have the potential for gain and no potential for loss.
And so if I have that mentality going in, the worst I could do is the same I'm doing today. But the best I could do is I might be able to save myself some money and pocket that as the insurance company that I actually own now.
Correct.
Okay, so if I'm a company...
Can I introduce?
No, please.
Yeah. I mean, I'm thinking about one client. They're a large staffing company. And, their workers' comp was in the $6.5 to $7 million range a year.
A year. Wow.
And their processes and procedures were great. I mean, their claims were low, and they were paying money every single year. Workers' comp is about a 50% margin business. Think about it.
Wow.
You pay $1 million a year in workers' comp, the insurance company expects to pay out $500,000. If their paid and incurred is $800, even though they may have only paid out $100, but if they say, oh, you had a bad year because the claims are going to materialize and it's $800, they get to recoup that $300,000 at $100,000 a year over the next 3 years through the XMOD. So they're never, that's why we got into the workers' comp game. But now they became so good and so profitable that their insurance company is now a licensed, admitted insurance company to write workers' comp in their state. So now where they were making all their money just in staffing, now they have a whole new side of the business where their insurance company is actually the cash cow because they write not only for their employees, but they now can write to other businesses that exist in that state.
Can you actually be a captive insurance for somebody else?
You can get licensed.
That's what I just heard you say.
You can get licensed once your capital and surplus gets up enough. Now they're a licensed, regulated insurance company that can write to the general market. So
so sometimes it blossoms into a whole new business.
Take Allstate as an example. Allstate was an insurance company, a captive insurance company that was created just to insure the product defect Craftsman tools. That's why they're in the Sears stores. And then they just become bigger and bigger and bigger, and now Allstate is what it is. It's a fully licensed insurance company.
Wow. Well, listen, don't forget to watch our next segment, Selecting the Right Fiduciary, part 5 of our series on captive insurance companies, the business alternative. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.